Hello to all of you and good afternoon or good evening, depending uh, on where you are at the moment. This is the second session of the MOOC, the second live session of the MOOC, which we organize today in cooperation with UNO. And this second session of the MOOC will be the opportunity to discuss the questions you may have raised, you have an intention to raise, and we will handle those questions live. And second of all, I will also take the opportunity of this second session to bring upward or upfront a couple of important themes and couple important topics regarding the infrastructure finance, and in line with what I did for the first live session, and which definitely is important for the journey of the infrastructure finance MOOC, not only for the journey but also for your overall interest and curiosity about the topic of infrastructure finance. So as we started really at 6 sharp, I am aware that some of us, some of you may have some problem joining on time and may want to have an extra cushion of few minutes. Therefore, I will hold off and probably wait for a couple of a little more than a couple of minutes, say 4 minutes, so that everybody can join. And so I would start then the this live session. So I would allow for, I would say, 3-4 minutes of additional time as we would we would wait for the other participants. Okay, so I will start right away. We have an hour in front of us, and I would like to use this hour for the profit of those attending the session. Obviously, if you have questions, I am here to answer those questions, and don't hesitate to write those questions. This question will be conveyed to me, and I will happily answer to them, each of them online. And obviously, for those I won't be able to answer online, I will answer it offline. Today, I would like to stress and to um, I would like to share with you some additional content, precisely on the same line of thought that I shared the first content with you, and this content is about an important themes of the infrastructure sector, which is the risk return map. Um, finance is about risk and return. Finance is about risk and reward. As we say in finance, we don't have any free lunch. Therefore, uh, when there are return, you may 100% sure, you may be sure that 100% of the time you have also risk attached to it. So to illustrate that in the context of the infrastructure sector, I was willing to show you this interesting mapping of infrastructure sectors um, on the risk return matrix. So on the risk, on the x-axis you have the risk, and on the return axis, on the UI axis you have the return, as is usually the case in finance. And what I would like to address now is the different type of infrastructure you may face, and where do they uh, situate themselves, what is their mapping on the risk return matrix. Let's start with the most I would say conservative type of infrastructure, the one which is very low risk or low risk, and relatively and to a certain extent very low return. So very low risk, very low return. On this particular segment of the map, you have what we call social infrastructure. Social infrastructure is made up of any type of infrastructure, be it hospitals, schools, government accommodation. We could also, in some country, put in this category universities. We could put things like prisons in some cases. Well, typically, we 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 tend to label social infrastructure as an infrastructure for which the user doesn't directly pay for the service that he benefits or she benefits from. So the question you may ask is, if he or she doesn't pay, who pays for it? And the answer is the whole community pays for it through its taxes, obviously. And we in our countries, mainly the OECD countries and many more, we don't pay for hospital the real price. We don't pay for schools, necessarily the primary and elementary schools and the high school. We we don't pay we don't pay at all, or if we pay so minimally that it doesn't represent the real cost. And obviously, what help financing those infrastructure on the operating and investment side is the taxes that are levied on the population, be it local or federal or government or central government taxes. These taxes participate to the financing of the operation and investment or capital expenditure of these infrastructure. So on this particular type of infrastructure, social infrastructure, as we call it, you have also, and I would put into this category, road and rail, whose terms of payment are availability based. I would revert on what I mean by availability based transport here. But typically, this social infrastructure is characterized by this high degree of resiliency to economic cycle. Whatever the economic cycle is, the essential need this infrastructure fulfills will lend it a resilient characteristic. Therefore, it is highly unlikely that this infrastructure will be sensitive to economic ups and downs. For this particular reason, when you do infrastructure finance, when you basically structure an infrastructure finance deal out of this social infrastructure, you would usually, as a private party, you would usually get paid through government payments. So government payment would be in the form of availability payment schemes or uh, regular lump sum payment that you would be paid to operate the infrastructure itself. So let me give you a couple of examples. You want to operate a general hospital and ensure in this hospital a facility manager role. So you would ultimately operate the hospital on the facilities, and you would make sure that all the current maintenance of the infrastructure is covered. So for that, you would play your role of operator. And for this role, you would be paid a lump sum fee by on a regular basis. It could be quarterly, it could be monthly, it could be semi-annually by the government in charge of the Ministry of Health. You would be paid an amount for 15, 20, 25 years, depending on the term of the contract you sign with the government. So in this particular type of infrastructure, you are completely uh, independent from any economic cycle. You are resilient to the economic cycle, and the only thing which can happen is that the state decide to not to pay you because it can't or because it doesn't want. Obviously, you may be faced with a government entity or government ministry that may not have the ability to pay you. So this is a credit risk, and even if we are in countries where the risk of counterparty from the state is relatively minimal, we have seen in the recent past that this situation of having a credit risk on a government is definitely something which we now should consider as serious. Therefore, a credit risk may always exist. The credit risk may exist in the fact that the government, notwithstanding the fact that it wants to pay you, cannot pay you because it doesn't have the money. So that's a first risk. But I would rather switch to the second risk, which is obviously the most prominent, is he has the ability to pay you, but he doesn't want to pay you. Why? Because he judges that you didn't do the job as you should have done it. So you have a specification, a set of specification you shall comply with. You have a set of terms and conditions, and this term of condition, when not fulfilled, are typically something on the basis of which the government can uh, base its argument not to pay you, saying, you know, you didn't do this as I was intending you to do it, or you did it partially. So as you did it partially, we will pay you partially. We were due to pay you 100. In reality, we will pay you 80 because the 20 deduction is due to the bad operation you have done. So a lot of these deals, which are situated in this region, a lot of these deals are about service performance. So whenever you do a transaction in project financing in this area, you should partner with, if you are a financier and participating to the transaction, you should partner with strong, uh, high reputation operators having already an experience in the field to avoid any deduction on the operating fee that they will get from the government. Otherwise, you may have problems in the financing. Another problem we can face is operating cost overruns, because as you sign long-term contract, as you have a long-term obligation, it is possible that the cost incurred, the cost you forecasted at you budgeted at the start of the project is significantly less than the true cost. As such, you may run cost increases and cost overruns, which you will not be able to pass on to the client. The client being the state or the government body with whom you contracted at the first place. Then you will have to swallow those costs at a price which over time could hurt and harm the economics of the transaction. So that's something which you should be aware of. In the second in the second part of the graph and the second part of the mapping here, we have the what we call the regulated infrastructure. And the regulated infrastructure is a is still a low risk transaction type. That's why it's situated in I would say the left hand part of the bottom left hand part of the map here. But as you can see, it's a little bit higher than the social infrastructure. Why? Because it's partially risk attached to market risk and partially regulated. I would in this category I would talk about regulated assets like energy distribution or transmission. We could also have that in the water and sewage sector in the UK, for example. We could also have the off-take agreement in renewable energy, whereby you would sign an off-take agreement with a significant corporate which will commit to buy you a minimum level of minimum volume of energy for a certain price and for a certain time. So it could be 15, 20 years at a price which is obviously indexed, but adjustable rates, but for a minimum of volume each and every year. So that would be ensuring you or securing you a flow of revenue. Obviously, that's a regulated infrastructure. Telecom fiber is also another one, and concession of toll roads is a regulated infrastructure. Regulated in the sense that you can't do whatever you want. For example, the government cannot, if they sign a concession agreement with a toll road operator, he would commit for as long as the concession exists not to put a competing infrastructure in a radius of say 100 and 125 kilometers of the toll infrastructure, so ensuring you a captive market. That would be one possibility, but it would also regulate the type of tolls you can charge the users and at which pace you can increase those tolls over time. So these are regulated infrastructure, still resilient to economic cycle. Why? Because we are touching on essential services to the population here, but still open to market risk, still started to open or being exposed to market risk. Even if the volume risk is still low, you may have a regulatory risk. Why? Because regulators in those countries, in our countries, may change their mind. We know that. They may change their mind and they may decide to alter the regulation they passed on at the first place, to change the name of the game and the rule of the game, which may hurt your infrastructure. The third point is the third graph, and here we are really moving from a low risk to a moderate to relatively high risk, are performance link infrastructure project, and specifically linked to economic cycles like demand-based infrastructure, the towers, telecom towers, obviously, which is largely part of the demand of telecommunication from corporate, from the industry, from the households, obviously ports and airports, tolls and bridges, and any type of real deal which is non-based on availability paid by the government. These are demand-based infrastructure, highly plugged to economic cycle. It is a fact that as the economic cycle goes down, people are less traveling, they are they are using less their car, they are also more sensitive to paying tolls to tunnels and bridges. They won't use airport as much as they would, and this has an impact, obviously, on your economics. So there is a volume risk and there is a pricing risk. And the last one, obviously, is the most risky and which also gives best return is market infrastructure, where you are fully exposed to competition, market and volume and pricing risk. And this is a type of exposure which I would qualify as private equity type, where basically you have no particular offtake agreement on your power supply. So you would produce a power energy, but nobody would buy it necessarily on a contractual uh, fashion, but they would buy it in the open market. So we call it merchant power. Or you would have also the service stations, the waste. These are market infrastructure, and we could also put into this leverage buyouts done on infrastructure like airports, where you purchase an airport from a private party through an LBO, for example. Here, you would be typically in a situation where you are uh, running a risk of private equity investor. Okay, so investment risk, and this is the takeaway, investment risk in this infrastructure are highly influenced by these resiliency or exposure to the economic cycle. Obviously, as the more you move the more you move northeast, the more you take pricing volume risk, for sure, this is important, and also influenced by the geographical area where you are, for sure, the essentiality of the service you provide to the population. The more the service is essential, the higher the resiliency to the economic cycle. And finally, and we will see that in the next slide, you are also influenced in the risk, uh, whether your project is in at the early stage of its development, we call it greenfield, or at a more mature stage of its development, we call it brownfield. But before switching to this second topic, let's see if we have any questions I may address before I switch to the second time. So I'm seeing here, uh, I'm looking at my desk. If I have any question I could address, I would do that right away. Otherwise, I would basically move to the second part of my presentation, which has to do with the economic cycle, the type of stage of development your project is in, what is the phase of development your project is in, and how this phase can have an impact on the risk you take as an investor in the project. So let me just look at this possible, if I have any possible question I can answer. Not for the time being. So if I have no particular answer, I would continue on my theme today, which deals with this risk stuff. So what do we have here? We have we have an x-axis which describe the time, and as you can see, this time is relatively extended. We start, it's 20 plus years, it could be even 30, 40 years for certain contracts, and this extends to 30, 40 years for certain contracts for sure. And on UI axis, we have the risk-free rate at the bottom, and at the top, we have the risk premium. And the idea is, what's the cost of the financing is in my project, how big is the cost when I incur the project. And I think what is extremely clear, as you see this graph here, is that the project risk are accentuated and concentrated on the development and the construction phase. The development and the construction phase, which could last at as much as 2, 3, 4 years, maybe for some projects. This phase, which starts with the feasibility study, the development of the phase, the studies, the capital. I would say the I would say everything which is intangible here, everything which has to do with feasibilities, um, I would say sunk cost in a way. This phase, which could be a year or 18 months, is obviously the riskier part, because you don't know here at this stage, you don't know if you're going to do the project or not. You don't know if you are going to go into the project. You have not yet started to think, you have not yet begun to consider the project positively. Then you have the construction phase. The construction phase could go from, for simple project, 2 years, more complex project, 3 4 years, even for even more complex project you can go as long as 5 years, during which you build your project. Here in this phase you have already decided you would go for it, and you are in an execution phase, and we call this phase the greenfield phase, where you have not generated any revenue yet. You have simply started to build a, an infrastructure that will be sized to service a population area, and be it a toll road, be it a bridge, be it an airport, this infrastructure will be calibrated to serve a service area, and this service area is defined as a population level of population needs for this infrastructure. So this construction phase is extremely risky for those who would venture into it. Precisely here, we would rely on the type of capital resources we will rely on are mainly equity, and we would also involve debt in the construction phase, debt in a substantial manner and size. Why? Because unlike a typical startup, which has almost nothing to trade except its willingness and talents and ideas, we in the infrastructure business, we have more to trade than that. We have a collateral. The collateral is the infrastructure we will build, but often the collateral is not your property, it's not your ownership, and you can't give it as a collateral to the banks, because you know that at the end of the day the infrastructure will revert to the state, and it cannot be pledged in favor of the bankers. But rather you have a collateral which has an earning power. You have something which will produce revenue for a long and long term, long years to come. And this in itself, this earnings power, is tradable, for which you can uh, encourage and convince financier to step in. So financier, when they are convinced about the economic model, when they are convinced about the business model, when they are convinced about the fact that you can earn your living, decently earn your living out of your operation of the infrastructure, they will happily jump in. They will complete the equity stake you would put, and they will participate to the construction cost. For sure, depending upon the sectors in which you are, depending upon the type of infrastructure you build, this percentage of debt which they will accept to put here would differ. Typically, if I look at my graph back here, if you ask bankers to be involved in social infrastructure or regulated infrastructure, they would not necessarily, well, depending on the terms of the contract, but they would be reassured by the counterparty, they would be reassured by the terms and conditions under which you will be compensated for long term. They will consider you are secured in a way by your monopolistic situation. As such, they would rather commit for percentages of debt which could go as high as 95% in the best case, but more often 75 to 85%. Here, in this particular segment, here or there, the banks would basically be more shyer, I would say, to go to these levels. They would rather commit on either par, I would say, 50% equity, 50% debt, or little more than par, which says, okay, 60% debt, 40% equity. Particularly in the airport sector, they would be cautious not to go on the north part of this 60-40. And that's an interesting relationship, between the phase in which you are and how much committed the banks would be. And you have the so-called transition phase here. Depending on the infrastructure, this transition phase could last 1 or 2 years. This is a phase during which the risk gradually decrease, not in a generally not in a, I would say, proportional, not in a uh, gradual way, rather in a steep way. Transition varies between infrastructures. Typically, a toll road, we call it the ramp-up period. The ramp-up period in a toll road could be as long as 3 years, but in some instances, the ramp-up could be 8 months. It depends on the advertising you make on it. It depends on the the channel or the corridor, the traffic corridor, uh, where is situated your toll road. Is it a affluent corridor or is it a growing corridor? Depends. So you transition phase is a phase where gradually the risk you accumulated here would drop to reach a low point at the end of the transition phase, which will be then uh, will stay or hold off for a long time, and only after a certain while will start to decrease. So you can see that the decrease here in this risk part is low. Why? Because usually when you reach that point, vast majority of the risk are behind you. Construction cost overruns, delays, uh, unfeasibility of some things, ramp up period, all that is behind you. Therefore, you don't have a lot of risk uh, in front of you. You simply have to manage the infrastructure correctly and make sure you do your role as you fulfill your role as an operator as you should fulfill it. And typically here, this operating phase, which usually lasts 20 years or more, is the opportunity offered to participants, investors, financiers, uh, banks also, operators, contractors. This period allows them to get their money back gradually, get their money back through dividend payments. But obviously, after a certain time, once the debt is repaid, to get the full upside of the available cash flows. Obviously, because as you have paid the debt back, the only people sitting around the table are shareholders. Therefore, they will share the cake of the dividends. And this is precisely after a certain while, probably around here, that you would get all the dividends will be paid to the investors. It will be all the cash flow remaining at the end will be devoted to the shareholders. And this period of time will appear or happen at the tail of the time of the concession, probably during the last, I would say, 6 7 years before the end of the concession period. So that's how you have, how you distribute the risk among the period. So to summarize, you have the highest level of risk here is commanding and attracting high risk premium from the investors, obviously. And as you start to go there, you would attract much lower premium from the investors. So what often investors do is they mix and they bundle different type of projects in a portfolio. So typically they would start to bundle different project type. So if I am an investor and I want to constitute a basket of project, what would I do? I would take if I am not if I am risk averse, I would rather pick and choose this one. But if I want to distribute on my risk across the board, I could choose and pick one of those, each of those basically, and constitute, I don't know, a portfolio of 2 projects here, 3 projects there, 3 projects there, 2 projects there. And then once I have taken this project, I can also distribute my risk here by, out of my 10 projects, taking 4 under operation and 6 on a greenfield side. So you can distribute the risk. You can uh, uh, in a way you can distribute your return as well by taking into your portfolio different project of different stage of development in different sector of the economy. And I think that's a good way to participate in the building of a portfolio that is a balanced portfolio, particularly for investors who are new to infrastructure and who wants to test the water of the infrastructure, but keep the diversification benefit of it. And I think it's a good way to start. I'm looking for any questions. I don't want to be the only one to talk here, and if there is any question, I would definitely address them. So I'm told there is no question so far, so I would move on then. And again, on the same themes, I would talk about risk and return profile according to this particular, you know, conundrum I have mentioned, which is on one end the the value of the assets. So the value of the assets is clearly what is the value of my concession, what is the value of my infrastructure project, typically what is the value of this project. And in contrast to this value, I would look at the development stage. And if I look at this graph, what do you have? We have the greenfield assets. So these are assets which are assets highly, I would say, capital intensive project. You have to 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 bear the development and design and construction phase, and this is definitely the riskier portion of your project here. The second is the assets which would have to be developed. So these are the assets which are assets in which the essential part of the investment has been made, but you can redevelop the assets. In other words, you can add capacity to the assets. Typically, I would take the airports as an example. If you are an airport, you build the airport for a certain capacity. I don't know, maybe 30,000 movement per day, and 30,000 movement, per year. And you decide that to to face the demand, you want to increase the capacity of your airport by building a new runway and building a new terminal at the same time. So you would redevelop the asset. You would start with an existing asset. Okay, this is this type of assets here. You have an existing asset which usually runs well and for which you have decent returns, decent cash flows. But because of the fact that these projects are scalable and you can scale them, you need to adapt your asset base to the demand. And this adaptation uh, necessitates you being involved in additional investment. And so you would invest in the runway, you would invest into the terminal. As such, you would redevelop the asset. And that's another possibility of enhancing the value of the asset. That's why that's the sense of this graph. You start with a greenfield asset, and this greenfield asset has many good characteristics, but let's face it, many challenges as well. I mean, you have to face, as I said, the development, the design and construction. You have to face ramp-up period. You have to face the period of patronage and the operation. And these are all the risk over the asset life cycle you have to face. Um, for sure, if you were to select only these assets on your portfolio as an investor, you may consume a lot of energy, a lot of capital, and for some of those projects, you may also be hurt by the low economic performance of it. So you have to balance these assets, which we call the greenfield assets, by other assets which are already in operation. I cited the example of an airport here, where the airport is running well, but it has to increase its capacity. It has to increase its capacity, and for sure, it needs to redevelop a runway and a terminal. So here, you would enhance the capacity, and you would also enhance the value of the asset at the same time. You would enhance the value of the assets. You would bring the assets to another level. Another type of assets you may want to invest into is a mature asset. So mature assets are assets where you get high yield. Um, you have you're running usually assets here which have already an existing life of 15 years, or at least 15 years behind them. So you are still having 10 years in front of you, or 7 to 10 years in front of you before the project mature. But the mature asset have already demonstrated their viability. They already demonstrated their capacity to generate stable and predictable cash flows. So how would you redevelop the value of these assets? How would you increase the value of these assets? They are probably at their peak at the moment. And okay, you are not in this mode, but if ever you were willing to sell it to the market, you could sell it at their peak. And for sure, that would earn you a significant amount of money. But you can't do that because obviously you are operating the assets, and you know that the asset is not yours, it's the property and the ownership of the state. So at one point in time, you would have to give it back to the state, right? So this is not something you can do, but you can still think about redeveloping the assets internally. Like, for example, if the project is 15 years already old, a large part of the risk are behind you, but you still are with the existing funding. You are still with the existing financing. And the existing financing was the one you contracted 15 years ago, at a time where the project was risky, at a time where the returns requested by the capital resource provider was high. Therefore, you may be tempted to refinance. You may be tempted to repay your debt and refinance it with a cheaper debt. You may be tempted to re-leverage the structure. You may be tempted to to monetize in a way, earlier than you had anticipated, your revenue, to monetize your revenue through re-leveraging the structure, monetizing the value, and in the form of dividends, by giving to these mature assets a higher level of liquidity in a way. And that's how you could re-leverage the transaction. So there is an important takeaway here, which I think you should keep in mind as we move on. The first is, as the project risk decreases, and this is the case here, as the project risk decreases, the value of the asset increases. It's quite intuitive for the financiers because if you reduce the um, return, or if you reduce your um, discount rate in a way, the rate of return you require as an investor, as you reduce it, you would increase the present value of the future cash flows, and as such, you would increase the value of the asset. The second key takeaway is about the yield to capital growth profile. This yield to capital growth profile, and the capital growth profile is this typically, uh, changes as the risk of the project changes. As the risk of the project changes, the yield to capital growth profile also changes. And I think that's a second. That's basically a corollary, or there is a link between the two for sure. But it's important also to mention. That will be my last message of this session. It's about the cash flow profile and the stability of this cash flow profile. Uh, it is clear, and I think you probably got that since we started to talk about the infrastructure project. It is absolutely clear that uh, the project finance or the infrastructure finance area is an area where by no means is comparable to any other type of finance, corporate finance or private equity, for example. Corporate finance is about instability, it's about volatility of the earnings, it's about competition, it's about exposure to market forces. Private equity is the risk at its highest, it's the risk at its best. It is also the magnitude of the risk taken is the highest. So, uh, and the visibility and the stability of the cash flows in neither case is ensured. In an infrastructure finance world or project finance world, this is fairly different. You have a contract. The contract you sign with the public body, be it a public private partnership or a project finance, this contract has rights and obligations. And these rights usually and almost exclusively give you the uh, monopolistic situation to levy a fee or a tax on the users for a very long term period. And that should, in normal situation, where you operate the infrastructure uh, adequately, this should ensure you a stable cash flow profile and a steady stream of cash flows, at least predictable cash flows. So if you look at this graph, which shows what are the various cash flow, you can see that, I mean, it's like a bond in a way. It's like a bond. Look at this. It's like a fixed income instrument. Um, we have a long-term profile, 25, 30, 35 years here. And whatever you invest into debt and equity, whether you invest into debt or equity in a project, you will have comparable investment profile than the one you would have if you would invest into a fixed income instrument like a bond. Let me demonstrate that to you in a few minutes. Once you have the construction phase, where you make the initial capital investment, so you cash out here, an initial capital investment, and this is this phase, which is the construction phase. That would be comparable to the phase where you invest into the bond, for example. You buy the bond. Then, following this phase, and for a relatively long time, you will have the operation phase starting, and the operation phase would ensure a steady, relatively predictable and stable cash flow streams, which is comparable to the coupon you would get in a bond. Typical bond, you would get a coupon, say 3%, for example. You would get 3% semi-annually or annually, and this could be compared to the coupon you would get from your investment. And for sure, that would be qualified as cash flow from investment. So this would be cash out, that would be cash ins. And this here, this phase, which start at the beginning of the construction phase and ends a few years after the operation phase started. This phase, we call it the transfer phase from the greenfield project to a brownfield project. So greenfield project, brownfield project, greenfield project, brownfield project. And for sure, it also commands a transfer from a population of investors who would step in here and step out there. So investors would start to buy the project here and would sell the project at year 5. So all in all, they would invest 8 years. But they would like it because at the time they sell it, they will sell it for the present value of all these revenue coming in, you know. And that definitely is at the peak. A large part of the risk is behind them. They can sell an infrastructure to brownfield investors, which would produce for a very long time revenues stable that would ensure them a revenue profile close to or comparable to a fixed income instrument. So that's a very interesting point here. Investors who invest here are not the same who would take or jump in here. They are different. These would be typical greenfield investors. They like to buy and they have like the risk. Those who would buy brownfield here, they would jump in here. And thanks to those investors who would sell to them, these investors, we call it brownfield investors, they would rather be risk averse and they would rather look at profile like this. Okay. So this is typically where the transition happens. Where does this cash flow come from? Well, this cash flow come from the interest and cash flow come from the investment. Obviously, cash flow come from the uh, infrastructure project, and this cash flow is used to pay interest on the debt, senior debt, and repayment on the subordinated debt, and also to a certain extent equity dividends. So in this phase here, you have a significant portion which corresponds to the payment of debt holders, be it senior debt or subordinated debt, in the form of interest and principal, and for a minor part of it, to equity dividends that you pay to the shareholders. When I say a minority, because obviously in the waterfall of payment during this phase, and this until all the debt is completely extinguished and repaid, the investors will not have access to dividends until and unless the bondholders and the debt holders have been paid in priority. In other words, when you see this cash flow here, I would say 80% of them or 85% of them are for the debt holders, be it senior or subordinated, and 15% or 10% are for equity holders. Equity holders will always come last after the debt holders are paid. And finally, here, I would say this is the last part of the project, and that usually happens in the 7 to 10 years, or I would say 7 to 5 years before the end. You have repaid the debt. There is no debt anymore outstanding. So you are only between the shareholders here. You have no bankers at the table, and for sure, what you would do here, you would increase the significantly. You would release from the box. You would release all the cash flow available to pay to the equity investors, and this is why you can see a peak here, a peak of payment, a peak of cash flows. It is because you have released from the lockbox, in a way, all the cash dividends you could not pay yourself during this period because of the debt holders capturing the large part of the cash flows for their benefits. Therefore, once this once you get out of the prisons, in a way, the bankers put you into, you can release the whole dividend for the shareholders. And for sure, you get your money back at this particular point. You have to be patient, but you get your money back at this point. And to finish on this, I would say that uh, trying to compare that to a bond, you will have the payment, the investment in the bond, the coupon payment, and at the end, you would have the bullet repayment of principal at the end. Highly comparable to, highly comparable to the bond structure you may invest into as an investor. So that was the message I was willing to share with you uh, uh, this evening. I think I I think it's really an interesting part, I would say, of the infrastructure project. I would definitely address questions, not necessarily now because it's close to 7, but most likely offline in the forum. I would nonetheless address the last question, which was asked by one of the participants here, which is, where can I get more information on project finance training and courses? Oh, well, there is a wealth of resources on the web which deal with project finance training and project finance courses. I hope that you, the participant who asked this question, and I understand you finished the MOOC. I hope you enjoyed the MOOC, you enjoyed the experience, and you got the test of it. And because you got the test of it, you want more. It's a good thing, by the way. I like this. You can get more training programs. There are a few of them are relatively, I would say, good standard. I wouldn't say good standard, I mean value for money. Depends on the type of training you intend to get. If it's an extensive training or an intensive training, I know both. I know intensive training, a week's time, or basically you work 7 days a week, and out of that you crunch the numbers, you crunch the contract. It's a highly intensive program. On the other side of the spectrum, I have also resources, training resources on the web which offer extensive training on project finance. What I could do is probably provide you in the forum with useful links on trainings, additional trainings in project finance, be it on the project finance technique itself or uh, things peripheral to project finance. Particularly, I was thinking about modeling in project finance, which is a hot topic. Project financiers do a lot of modeling, and we often ask, how do we do modeling in project finance? Is it complicated? Yes, it is complicated. Is it far more complicated than doing modeling in corporate finance? Oh, for sure it is. It's definitely more complicated. Then you have a lot of parameters to take into consideration. Any one of you who had already touched on a project finance model knows how those models are um, tricky, and you have a lot of things to do. I have done modeling. I'm still doing modeling for project finance, and I know this topic for sure is a tough topic. You have some interesting training I could refer to. I could refer you to, and I will not fail to do that. In the forum, I would post several links which give you an example of intensive training, extensive training, and training on financial modeling. Okay. Um, I think we are reaching the time now that we have to part, and I would like to thank all of you participating into this second live MOOC session. I am I was extremely happy and I enjoyed participating in his live session because as you probably noticed and gathered, I am a passionate project finance person, and therefore I like to transfer my view and insight on project finance. Therefore, I would I appreciate a lot these live sessions, and I understand it may be the last one. So I encourage you, all of you, to continue your journey through the MOOC. Enjoy this journey and continue to exchange with me on the forum whenever I can. And I would definitely I would definitely take the time to answer to all your questions and address your problems and issues. Thank you very much. Have a nice day or evening, depending where your time zone is. Thanks.